In the final installment of the Economics in Crypto series, I'll summarize my cryptocurrency investing strategy, which builds upon the concepts discussed in previous articles. To recap, we began by exploring the three forces that Ray Dalio suggests drive an economy: productivity growth and the long-term and short-term debt cycles. The short-term debt cycle typically spans 5 to 8 years, while the long-term debt cycle lasts approximately 75 to 100 years. Understanding these debt cycles fundamentally changed my perspective on economic fluctuations. I saw that what appears to be an economic hardship is merely a phase in a larger cycle. This realization helped me tune out media-driven pessimism during downturns and focus on actionable strategies. Previously, I ignored sound economic principles, allowing media narratives and public sentiment to shape my financial outlook. I assumed that hard work alone would ensure financial stability. This mindset, however, prevented me from leveraging the insights offered by debt cycles to make informed investment decisions. The wake-up call came when I envisioned myself working at McDonald's, managed by an 18-year-old during my retirement years. This grim prospect motivated me to take full responsibility for my financial future. While short-term debt cycles offer cues for investing in riskier assets, the long-term debt cycle signals the need to diversify into hard assets outside the traditional financial system, especially when we approach the period of potential regime change. Crypto investing strategy: increasing your surface area. Surface area in investing refers to the breadth of your knowledge, exposure, and engagement across the investment landscape. By expanding your surface area, you can better understand risks and identify opportunities. Strategies to consider: diversify your portfolio. Diversification is essential. Allocate your investments across various asset classes, industries, sectors, and regions to mitigate risk. Crypto-specific strategy. While I have other investments, my primary focus is on cryptocurrency. I diversify within this asset class by investing in cryptocurrencies and employing various trading methodologies. Explore multiple cryptocurrencies. Don't put all your eggs in one basket like Bitcoin. Diversify across cryptocurrencies with different use cases, technologies, and market dynamics. Invest in blockchain platforms. Cryptocurrencies operate on different blockchain platforms, each offering unique features. Consider diversifying across platforms like Ethereum, Binance Smart Chain, Solana, Optimism, Arbitrum, and Polkadot. Consider DeFi yield farming. Once you own your own cryptocurrencies, you might park some of it in smart contracts that offer yield. DeFi platforms can offer high yields, and they don't rely on traditional financial systems. Access different use cases. Cryptocurrencies serve various functions beyond their stores of value. Investing in those with different use cases can diversify your portfolio further. Allocate across market caps. Balance your risk and reward by investing in cryptocurrencies of different market capitalizations. Include stablecoins. Stablecoins offer a hedge against market volatility and are pegged to stable assets like fiat currencies. Research and due diligence. Always research thoroughly before investing. Understand the technology, the team, adoption rate, and potential risks. Stay informed. Keep up with the news, regulatory changes, and technical advancements that could impact cryptocurrency market. Set allocation targets. Decide what percentage of your portfolio will be allocated to cryptocurrencies and stick to it. Rebalance periodically. Review and adjust your portfolio to maintain your original allocation targets. Avoid over-concentration. While diversification is key, over-diversification can make your portfolio unwieldy. Consider regulatory factors. Be aware of the regulatory environment in the countries where your chosen cryptocurrencies operate. Use crypto index funds or ETFs. If you're uncomfortable picking individual cryptocurrencies, consider index funds or ETFs. Educate yourself. Stay informed on investment options, strategies, and market trends. Invest in emerging technologies. Look into artificial intelligence, blockchain, renewable energy, and biotechnology sectors. Long-term thinking. Focus on long-term investments that align with your financial goals. Consult financial professionals. Seek advice tailored to your financial situation. Consider impact investing. Invest in projects that offer financial returns and positive social or environmental impacts. Practice simulation. Use simulators to practice without risking real money. Stay disciplined. Stick to your investment plan, irrespective of market fluctuations. Monitor and regularly assess your portfolio's performance and make necessary adjustments. Pay your taxes. Cryptocurrency is not tax exempt. Keep records and pay taxes as required by your jurisdiction. I hope you found this series useful as you contemplate investing in cryptocurrency. Stay tuned for more articles exploring the fascinating world of crypto. Remember, it's not too late to invest. The industry is still in its infancy and offers significant growth potential. Thank you. I'll see you next time.